Okie doke, I'm just going to start letting everyone in. The recording's already started, so Dana, if you just start a minute. Yeah, 31 minutes past, that'd be great.
Good morning, everyone. Just to let you know, we are giving it a few more moments, letting people arrive. So you have about a minute or so to get yourself a drink before we start. Okay, I think we are ready to go. So hello again, everyone, and welcome to today's webinar. My name is Dana. I work for the KTN, and I will be your host for this webinar today. The webinar is part of the Bioeconomy Cluster Builder project, and KTN is collaborating on this project with IBIC, and the project is funded by the European Regional Development Fund. So today's webinar is about providing information on how you can finance your project. So you are going to hear about the funding landscape and what kind of investment is available so that you can make an informed decision what's best for you and how you can finance your innovation. today's agenda is as following. In a few moments, I'm going briefly over the housekeeping notes for today's webinar. If you have attended KTN's event before, you will be familiar with those. Then Russell Clark from iBioIC is going to talk about the Bioeconomy Cluster Builder project, what we are trying to achieve there and how today's webinar is fitting into this project. And then my colleague Emma is going to provide you an overview about the funding and investment landscape. We are also going to have a Q&A session at the end of the event, and we are aiming to close by 12 midday. So for the housekeeping, you will have noticed that you are currently muted, and this will remain so throughout the webinar. However, we really want to make this an interactive session. So after all, this webinar is for you guys, so you can really understand what is available in terms of funding opportunities. And we want to really encourage you to ask questions so you get all your questions answered. Please use the Q&A box for those questions, and Emma will try answering them as she goes along. And if this is not possible, as I said, we are having a Q&A session at the end of the webinar. Any technical problems, please use the chat box, and we are trying to address them. There will be a lot of information in today's webinar. So the webinar is going to be recorded, and the link to this will be sent out to you together with the presentations, I think beginning of next week. So with this, I'm going to pass on to Russell to talk briefly about the Bioeconomy Cluster Builder project and how today's webinar is fitting into this. Russell, over to you.
Thanks, Dana. Hopefully everyone can see my screen now.
Yes, we can.
Thank you. So good morning, everyone. I'd just like to add my thanks and welcome to everyone who's joined the event this morning. As Dana said, my name is Russell Clark. I'm a Senior Business Engagement Manager at iBioIC, and I lead the Bioeconomy Cluster Builder project for iBioIC. So just like to spend a couple of minutes talking about iBioIC and then move on to talk briefly about the Bioeconomy Cluster Builder project. The remit of iBioIC is to act as a hub between industry, academia, and government to help deliver the national plan for the industrial biotechnology market sector, which was developed in 2015. Why is this important? It's to help grow the bioeconomy in Scotland and obviously reduce dependency on carbon feedstocks and increase sustainable manufacturing. We use a number of tools at iBioIC to help us do that and deliver successful innovation. We run networking events. We are a member organisation. We have approximately 120 fee-paying members, as well as a significant number of academic members. We offer funding as iBioIC as an organisation, so there's a number of funding calls that come in at a regular basis, but we also help to direct people towards funding from other bodies. We've got a skills programme, so to date we have developed a significant number of talent in the skills pipeline across PhDs, MScs and HNDs. And we also have equipment centres, so the ability to validate your processes and scale them up to, at the moment, up to 30 litre scale, with facilities available at Heriot-Watt and also at Strathclyde. Bioeconomy Cluster Builder project started in April this year. It's a 3-year project, and as Dana said, it's funded by ERDF in partnership with Scottish Enterprise, and our partner is the KTN. The project aims to help iBioIC and KTN promote the bioeconomy and net zero in Scotland and the wider UK. And we will target key market sectors, including chemicals, food and drink, marine, and the agri sector. Both ourselves and KTN will engage with relevant industry sectors and deliver targeted events and workshops like this one. And we aim to create a clustering effect and momentum to deliver new supply chains in the areas where biotechnology or bioeconomy will have the largest impact. So the main areas of activity, in summary: network development, events, and project and bid opportunities. And for reference, you've got Dana's contact details and also my contact details there. So it just leaves me now to introduce our speaker, Emma Fadlin. As Dana mentioned at the start of the event, Emma will take some questions, so please use the question and answer mode. And actually, Emma would be happy to take questions at a series of points throughout our presentation or at the end of the presentation. So we'll try and facilitate natural breaks throughout the presentation. Emma has over 20 years of experience in the development of technologies, from bench to securing Series A funding. As a member of the KTN investment team, Emma works with business angels, VCs and private equities across a wide range of sectors. She supports numerous Innovate UK funding and finance and ISCF investment partnership activities, including scoping and briefing events, company investment readiness and showcase events. Emma helps companies to evaluate their business, commercial and to market plans, and links them to the relevant support, funding and network and investment networks. So Emma, it's over to you.
Thanks, Russell. Thanks, Dana. Welcome, everyone. I'm just going to share my screen now, so just bear with me. Can you see my screen?
Yes, we can.
And let's see if we can do a slide share. There. So
Right.
you should see my first slide. Is that good?
That's good.
That's it, right. Thanks, everyone. And thanks for the introduction again, Russell. So what I'm going to do is I'm going to take you through the sort of funding versus investment and get you to think about your funding and finance journey. And it's something that a lot of companies, particularly at an early stage, don't think about and spend enough time. A lot of it is driven by the grant culture and the short-term cycles around grant funding, and also trying to raise investment, particularly in the UK, when the amount of money that's available is really fixed around between 18 months and 3 years. But you do need to think about your funding and finance journey in context of where you want to go and what you want to do. So who am I? Well, you've already had an introduction. My background actually is originally from life sciences and sort of human health. I've been involved in kind of everything from instrumentations, vaccines and diagnostics. Sort of I'm an immunologist by training, so I've been through sort of a whole cross range within this sort of sector, and I've also worked quite closely in the biotechnology and sort of bioeconomy, though I have looked at everything from gambling software through to little apps that people have made in order to communicate at the school gate safely. So this is the great fun of working at the KTN. You've got my contact details there, and I'm also on the KTN website if you need anything. So what are we going to be doing? Well, we're going to do a general introduction to the funding ecosystem. We're going to talk about grant funding and understanding grant funding and where you can find grant funding. We're going to talk about investment, and then we're going to finish off on how to find investments. I've got quite a lot of slides to get through, so we're going to start off with you giving us a bit of information about your experience and background. So we're going to set up a poll now. Basically, we're going to ask you, have you raised investment? And if so, what type? And that will give me an idea of where I should focus this presentation. So vote away. For those of you who've put other, could you put in the Q&A box what that other is, please, so I know what you've done, just so I can have an understanding around that. It's a great number of voting, so well done, everyone. So those of you who said crowdfunding, is that equity crowdfunding or gift crowdfunding? I think that's a question to you, Ian. Yeah, so grants is not really is different to investments. Okay, so those of you who've hit other, that's fine, thank you. Okay, so looking at the poll results, we've got 53% of you who have raised investment and 47 who haven't. And the majority of you have been raising your investment, those who have, with friends, family, savings and in kind. We've got 12% business angels, 12% VC, 6% with university enterprise funds and 53% with other. So with the other, that's been around crowdfunding, various grants, and no investment raised. So that's fine. So thanks ever so much for that. So that gives me an idea about sort of the cohort that I'm talking to today, and kind of the areas I'm going to focus on. So I'm going to keep it quite general. But at the end of my slides, I've actually got a link to some resources which will be more, can be tailored a bit more specific to what you want. I think I can share the results there. So if you can all see them, just so you can scroll through before I move on. So thank you very much for that. It's really helpful for me to know what it's like, what my audience is like. Right, so moving on. So for a lot of you, you're not going to be very familiar with all of the landscapes, but what you can do is sort of think about what's available from the public sector around innovation landscape funding. And we are funded by BEIS. BEIS funds UKRI. UKRI's got the Research Councils, Research England and Innovate UK. Innovate UK has a number of funding and finance products, and they also fund the Knowledge Transfer Network, the Enterprise Europe Network and the Catapults. So all of these services, the Catapult, KTN and Enterprise Europe Network, are business and technology support areas for you that you should consider and explore. And with the Catapult, I'd say, don't just look at the obvious catapult. The reason why is that quite often you're enabling technologies or you need to access enabling technologies. And some of the other catapults may actually have the knowledge, capabilities, networks within their remit that can really help you unlock some of the technology challenges you have, whether they're manufacturing, process, rather than just focusing on what is the obvious sort of technology fit. EEN is your regional support network. They are there to help companies with high growth potential. And with the impact of COVID-19, a lot more funding has gone into the EEN to support you. Scotland is based in Glasgow, but this is also the Highlands and Islands. So, and the KTN, we're across the whole of the UK. Also, not to forget, for those of you who are kind of in that international markets, route to markets are going to be international, is the role of the Department of International Trade in supporting you with export and working overseas. And there's a lot of areas of support, everything from managing your IP and IP rights to having introductions into companies and organizations in country if you're wanting to collaborate or do work, joint work, joint ventures. And they also have sector leads who are very, very knowledgeable around what's going on and use the embassy networks as well. And also they're very highly engaged with the local innovation agencies. So it's definitely worth sort of thinking about them. And also don't sort of exclude the role of other government department funding. So it might be that DEFRA and the grants and programs that are delivered through DEFRA. Innovate UK, I think around 80% of the programs and grants they run are funded through BEIS, and around 20% are from other government departments. And also BEIS has its own funding programs that it runs outside of the Innovate UK funding. So do keep a lookout on all of those networks and specific funding, regional as well as national from government. So where are you going to find the funding? Well, we're very lucky in the UK. We have a very transparent system. You've got national funding, such as Innovate UK, BEIS funding, government funding. You'll have regional funding. And we also have devolved government grants and funding, of which this program is one example. So how is the funding done? Well, you've got challenge-led funding. And that is going to line up with the programs such as the Industrial Strategy Challenge Funds, the Towards Net Zero objectives. You're seeing things as well now around Sustainable Development Goals. You've got responsive, so the open calls, and that's for technologies that don't fit into the challenges. You've got innovation loan products that have come through Innovate UK. We've got investor partnership programs where you're linking grants to investors, and that's for both business angels and sort of further up with early stage VCs. And you'll have a number of managed programs that can be delivered through catapults and other centers of excellence. They're all out there for you to explore. You can work with your network clusters, you can work with your local Innovate UK leads, your local EENs or the catapults, and they can help sort of signpost you to what's around. For regional funding, you need to engage with your regional grant holders. So think about Scottish Enterprise for those of you in Scotland. In Wales, you'll have your own networks, Invest Northern Ireland. And also think about how you engage with your local enterprise partnerships and your growth hubs. They will also know about what other sort of regional specific grants, funding and programs are out there. And they will also be challenge led because they're strategic around what that sector wants to do and deliver. It's also worth knowing that some of the funds, you may not be geographically based in where that fund is working, but if you work with a company that's within that geography, and it's a collaboration, or it's going to help develop the capabilities or employment in the area, that you might be eligible. So do look at the terms and conditions. The devil is really in the detail. So what are the features of these grants? Well, there's duration around them. There might be amount of funding that's available depending on the stage and the project. There might be match funding that you need to bring in place, which means you need to think about where you get that match funding from. Is it from your R&D tax credits? Is it from equity investment? Some of them require you to work in consortia. Others might be, if they're early stage, it's for single companies. If you've got things like the commissioned research, the SBRIs, they're for individual companies. And there's small print. And some people, particularly with sort of come up, and I've seen raised in discussions around SBRIs, around IP rights and ownership, and some of the BEIS funding is in that way. And the reason why is that if public sector is funding technology, which is commissioned research to unlock a problem, if you haven't got the capabilities to deliver, then under fair commercial terms, there is that walk-in right that government can take that on board and try and exploit that technology. And the reason being that if it's commissioned research, now that can be problematic for some people in context of investors, but if you understand the context, actually it's very similar to what you see in other grants. Wellcome Trust have similar clauses in there, as do some of the other government grants. So do look at the small print. If you've got investors on board, do make sure that they're comfortable and happy with that small print. So other banking products and support are available from your regional banks. So you've got the British Business Bank, which is an economic development bank, and basically they've got 3 offers under that umbrella. You've got the Finance Hub, which gives you a lot of information and early stage products, as well as sort of growth and scalable products. You've got the Patient Capital Fund, and you've got the Business Investments, which is for later. I've put the links onto that, and in my resource page, I've got the British Business Bank. Really great resources and information, some really good guides, understanding about how you can access some of the funds and the support around there. And then if you're going regional, obviously you've got the Welsh Development Bank, and you've got the Scottish Investment Bank, which is delivered through Scottish Enterprise. I couldn't find a similar product for Northern Ireland when I was looking around. I don't know what the structure is there, so I do apologise for anyone based in Northern Ireland. If there is anything in Northern Ireland specifically around economic development banks, please feel free to type it in the Q&A box and we can share it. One of the things you need to be aware of is the EU state aid and undertakings in difficulty legislation. And that is being enforced more strongly in grant applications, and it's applicable to companies that are more than 3 years old. And it's when your accumulated losses are more than 50% of your subscribed shares. So if you want to leverage a government grant or a public sector grant, which is subject to state aid, then you need to make sure that you've got enough equity or capital in the business that you can you don't fall foul of this. So we do recommend people to speak to their accountants, understand how that works, and think about what sort of funding and investment you need in order to make sure that you don't fall foul of the undertakings in difficulty. And that's applied across the board for all of the EU programs. So I'm now going to move on to the funding overview and talk about external funding. And this is kind of the first section. So one of the biggest problems that I see in companies raising funding and investment is the fact that they really haven't got a clearly articulated, validated value proposition. Doesn't mean you don't know what it is. It means that you haven't told us what it is in your presentation, in your grant application. Grant applications often can be quite broad rather than specific around what you're trying to, particular problem you're trying to solve. And it looks like you're trying to bite off far more than you can actually deliver in that project. So make sure that you revisit your value proposition, that it is appropriate for the segment, the vertical you're going for, and that you really can clearly articulate the value of the pain that you're alleviating. So the size of the problem you're solving and what the value is to that company. And remember, it doesn't have to just be financial. It can be around all sorts of other criteria. So it's not saving company. It could be about retaining customers, reputation, maintaining position in the market. Make sure you have a very clear competitor analysis against your value proposition, and you're comparing the right competitors, both direct and indirect. And if you've got a really robust value proposition, a very clear competitor analysis, what's unique and special about you is really easy to understand, and how that then cascades down into your product. Now, why is this important? Because everything that I see failing in both grants and investment is the lack of a clear value proposition and a competitor analysis. So people say, well, what's special about it? What's different? Can they really do it? So for those of you who are at earlier stage, of which I can see, about 50% of the audience is, you tend to focus on technology at the very beginning. You have to. And the trouble with focusing on technology is you can fall into a trap of describing your technology, but not the problems you're solving. And what's interesting to a fund and investor is how you're going to add value to the customer and why you're better than the competition. So you've got to convince the funders, the investors, that a customer will buy your product because it's useful, but actually it's not just about buying your product, it's the fact that your business can grow and scale. Otherwise, you become what's called a lifestyle business, or you're developing a product just for one customer without thinking about scalability. And particularly when you're moving on to moving away from early stage investment, angels, latest second stage maybe angel funding and your VC funding, if you can't grow and scale and you haven't thought about that, then they're not going to invest in you because you're not going to give them the returns on investment that they're looking for. So the challenge you have is, how do you segue from research to focusing on development and commercialization? And the challenge I'd have for all of you is to think about your commercialization plan. You need to have a really clear commercial plan. You need to think about what your pathway is going to look like and how long it's going to take. Unfortunately, when you're in industrial biotechnology and these bio clusters, it takes a long time. You know, you've got regulatory, you've got proof points, you've got scale up points. So you really need to think about the different points, what milestones are going to be, how that's going to be an uplift in your value of your company, and how you're going to reach that market. And then on top of that, build your financial strategy and make that really transparent. So what happens is people and the applications I see coming through, particularly around investment, the financial strategy is around the technology, but the commercial milestones aren't there. That can be in grants when you look at the Gantt charts and the programs, and the commercial milestones aren't clear, or they're not convincing, because you'll suddenly see this hockey stick rise in customers without any consideration around sales cycles. You know, how many demonstrators you might need to run in parallel, how you're going to service that. So what we want to make sure is you think about your commercial proof points, find out from funds investors what they want to see. They will talk to you about it, engage with them before you're trying to raise investment, understand what traction you need, i.e. what sort of engagement with your end users and your customers, clear differentiation, understand how easy your technology is to be adopted. And if you've got a turnkey solution, how is that going to be delivered? What's the cost to that? And what is the value chain that you sit in? Are you at the bottom of the value chain? Are you have very little influence? Are you at the top of a value chain? Therefore, you're very dependent on other people below you. How does that work? Where do you sit? Where are the risks in that position? And where can you go, or how can you maneuver yourself and get the right relationships to improve your strength in the value chain? The other thing I'd say is grants are a nice to have. When you're speaking to investors, having grants is lovely. It's a great proof point if you've got an Innovate UK grant where 5 external assessors have looked at your proposition and scored it highly enough that you've leveraged the grant, because that's a great sort of proof point. However, when it comes to growing and scaling a business, what investors want to know is how much money is it actually going to cost, and put as the grants as a nice to have, not part of your funding strategy. Put them in there. If you've got them, that's fine, but actually think over and above grants and think about how much you need if you don't get the grant. Being cash rich is the best place to be. So sources of external funding, in this way you've got grants, you've got debt finance, we've got crowdfunding, and we've got investment. But what we always want you to think about is sales. Never underestimate the sources business finance. It's a really great way of proving as well that people want your services. The more you can self-fund through customer sales, and that can be actually paid projects, is fantastic. And you can reinvest that into other products and service development, which gives you a little bit more wiggle room in what you're doing. Also, the more control you've got on the business, but you can also be distracted by that, particularly if you've got a consultancy offer around it, and it can take some time to achieve. And obviously in the sectors that we're talking about here in this cluster, it is a really tough area to get some early finance in. What I do say is always make sure if you're collaborating that you put a value on the service you're providing, even if you're not going to charge, so that there's a very clear expectation from the beginning about how much you're worth. And it makes it a lot easier then to negotiate how you're going to talk about the cost and the product if you do convert them into a customer. So do think about, always think of everything you do in context of a sales, even if you're not going to charge them anything, they know the value of the service you provide. So grants, great if you can get them. They're non-dilutive, they accept high risk, as seen as zero cost, but actually it takes a lot of time and effort to write a grant application, do it properly. You can't, as most of you know, if you've done Innovate UK grants, that, you know, it's not something you can knock up in a couple of weeks. You need to give yourself a good 6 weeks to do a good application. It adds great credibility when it's got external assessment, and it can help you leverage in other funding. However, particularly in the sector you're in, it can be very difficult to locate. They're rarely 100%. They can be distracting as well if you're working and it's kind of on a sideline and you've got to deliver against that, and particularly if it's not core. And they can be very paperweight heavy, so you need to have really good admin processes, and you need to think about how you're going to manage that from the very beginning. Great thing you have with Innovate UK is monitoring officers. As soon as you move into EU funding, as probably many of you know, the paperwork, the administration heaviness of them can be really quite difficult, sort of tracking everyone's timesheets and managing all of that. So make sure you've got the right processes in place if you are going to go down that grants route. And absolutely, as much cash that you can bring in that's non-dilutive is great, but don't let it distract you. So where are you going to find these grants? Well, we've talked about regional agencies, innovation vouchers, devolved governments or regions, and then regional national strategy hybrids, for example, the iBioIC that we're talking here. National, you've got SME funding and government department funding. On the European level, we've got Horizon 2020 closing off now. We've got SME Instrument Eurostars, and we'll have the new products. We still are under the understanding that the government's going to honour those collaborations, and I would highly recommend that you do look at those and think about building them. And the reason for that is also it opens up your market. And then you've got sector specific. So third sector, the charities, those sort of networks that are working in there. There are international grants, so looking at the Newton funds and some of those other products that are out there. There's corporate venture R&D. So if you're looking at, these are enterprise venture funds rather than corporate venturing funds. Non-governmental bodies, it can also give out funding, and then you've got the levy board models as well, where you can find funding and grant funding. So think about your sector and do a proper landscaping map as part of your funding and finance strategy, and actually update that, keep an eye on what the trends are, what things are coming through. There's some really great little pockets of funding, and working nationally, having a good relationship with your local enterprise partnership and your local growth hub is a really good way of finding out what's going on and what sort of partnerships you can have and collaborations. And if you're an enabling technology, look outside, look at who you can partner with in other local enterprise partnerships where there's a greater emphasis on investment in those sectors. Sourcing grants. So my top tips are really think outside of the box when you're sourcing grants. They are competitive, so think about where you sit and how much effort you need to put in to do that, and whether you want to go it alone or build a consortia, whether you want to be the lead or you want to be a partner in that. KTN can help. Think about the time it takes to write the application, give yourself enough time, and make sure that if different people are writing elements of it, you give yourself enough time to make them cohesive. Scope and eligibility, really do look at the T's and C's. Identify partners and what your supply chain looks like very early on. That really strengthens your application. Who are your early adopters, and what commercial milestones do you need to show and reach in order to fit into that scope and what that program's working on? It's really critical you understand those, and you, I suppose, map them out before you start your application. Commercialization and plans for commercialization. This is something you really need to think about when you're putting in grant application. So what are the T's and C's? Some grants you can't commercialize until you've come to the end of the program. I used to do quite a lot of stuff with sort of company sort of funding and sort of a semi kind of government private funding. And we reached our commercial milestone actually within 8 months of the start of the project, but we couldn't actually commercialize it to the end of 3 years because of the way in which that grant T&C was done. So that commercial partner walked away because they said, if we can't access the IP and address it and move forward, then what's the point? It's a real challenge. Foreground and background IP and rights, framework agreements versus consortia versus collaboration agreements, they all have different T's and C's, particularly if you're looking at European Union funding and collaboration agreements and consortia agreements with those. They can be very, very difficult of being able to respond very quickly, and your agility can be affected by that. Corporate funding will have very specific terms and conditions and how you work and your freedom to use the IP and IP rights. So these are like the corporate R&D funds. What happens if you meet an early commercial milestone? What agility and flexibility do you have? And I would always say negotiate heads of terms at the start of that agreement rather than leaving it to the end, because you can end up with a discussion like for 12 months post the end of a grant where you can't do anything and you can't really do much around exploitation, and it will affect you being able to leverage other funding. So do think about those challenges and commercialization, which is why I always say plan your R and your commercialization in parallel. Think of the best case scenario, worst case scenario. So challenges are showstoppers of who owns the IP, around the company, you're negotiating with freedom to operate, access to enabling background and future IP, time to negotiate, governing law if you're working overseas. We have the KTN have a really great top tips. I've got the link into that in my resource slide at the end, so just have a look at that. So I'll pause there and open it up for questions before we move on to debt finance. So if there's any questions, I haven't seen any in the Q&A, but if you have any questions, if you want to type them in, if not, I'll move on. Okay, I can't see any questions coming up, so I'll move on to debt finance. So debt finance. So if you're in a later stage or you've got enough turnover or some income coming in that you can pay debt, then it's a really great way of sort of not having to sell a share in your company, and you can actually even factor that against order sheets or any assets that you've purchased. So there's some really great products that are out there, but more suitable for later stage. So there's only 12% of you who've got VC funding who might want to consider that. But the pros of them, there's no loss of equity and they can be flexible. The challenges can be decision making is done centrally and these loans can be called in. So if you are considering debt finance, which can be very attractive, what are the benefits for you? What should you think about in context of being able to pay off that debt? What are you going to leverage it? And there's not a huge amount of it around for early stage companies. There are things like startup loans, which up to 25K for each director that comes with mentoring. That's a British Business Bank product. We've got the innovation loans from Innovate UK, which have been very successful. And there can be some links to public and private platforms. And there's also debt crowdfunding, like Funding Circle and other ones that are out there. And those are can be quite nice because actually the people giving you the money set the interest rate rather than the bank. So do think about that. Moving on to crowdfunding, that's very, very popular in a lot of areas. It's different types of products. And the UK is actually the leader on crowdfunding, and we have some really great platforms. So it's definitely worth considering that as a route to funding. But there are hundreds of platforms. Some of them are good, some of them are not so good. There's a lot of flexibility, lots of different options. You get a very nicely managed cap table for the investors when you're going for follow-on investment funding. The terms and conditions are there. It can help identify customer base depending on the sector you're in. and it can help validating that credibility for follow-on rounds. But the challenge is that not all platforms are regulated. Some use lead investors and nominee accounts, and you do need to create quite a bit of momentum before launch. And actually the amount of momentum you need is increasing, and you need to think about the cost of actually putting together your marketing collateral. And I'll talk about that later. So you've got 4 options around crowdfunding: debt, which we've talked about, which is not much different to traditional, but you will probably find that there's finance at a higher risk. Interest rates are set by the people who are going to give you the funding. There's no government guarantees. Equity, so you're selling a share in your company. You will need all of the classic information that you'll have for any investment for angels or VCs. There are lots of variations in how those platforms work, and you do need a pre-commitment, and some of them may need to have a lead investor on board. Rewards, not really relevant. Those are the kind of Kickstarter and work really well for consumer products, and some of them are global, and there's no need to prove the market, but it's a way of proving the market. And then you've got donations, which are not really relevant to a lot of your products, but maybe, so it's worth having a look at. So crowdfunding, what are the challenges around that? I think for me, the biggest challenge is that you now need to have around between 25 and 40% of the funds sort of already secured before you can get onto the platform. So you might want to look at, are there angel networks where you can get that kind of crowdfunding through syndication or through the large groups that they work with and they cross-refer, where you don't have to put in all that marketing collateral, you can go and do the rounds. Quite a large percentage of campaigns fail, up to 80%. It doesn't mean that they're all in this sector and the curator. This is the statistics across all the crowd funds. And also think about the target, the minimum target you want and what you're willing to close at. There's about a 50% success rate of reaching the actual target that they're aiming for. So there is a reach. So you do need to think about that, but you will have an account manager to work with you. And we did have somebody who's gone through crowdfunding, and it'd be quite nice, maybe the Q&As at the end, if you want to share any of your sort of experience around the pros and the cons. So at this point, again, I'll have another little pause before investment ecosystem, see if there's any questions. I can't see any that have come up on my Q&A. So I'll move on. So the investment ecosystem and investor perspectives. This is really important. You're not giving away your company. What you're doing is you're selling an opportunity to invest in a vision. Think about it as an angel investor. If I had money that I've made, I've got a spare 100,000, 50,000, £1 million to spend. What am I going to spend it on? If I've got that money, say I'm going to buy a nice car, a nice house, what is that brochure going to look like? What sort of service do I expect? Why, when you're selling a share in your company, would you not want to treat that investor, that community you're going out to asking for funding, in the same way as you'd expect to be treated if you're spending a large chunk of your own personal wealth? So do think about it from the perspective of the investor. If you're talking about VCs, think about the fund, how it's been set up and what it's looking for. And think about it in context of, is it a pension fund? What is the risk profile for that? Is it an evergreen fund, or is it a closed fund that only lasts for a short period of time? What is that investor or that investment portfolio looking for? And quite often, as companies seeking investment, we focus more on what we want rather than thinking about what the investor's looking for. So do hold that in mind. It's a negotiation, it's a sales process. Go in with an open mind and be ready to be firm but negotiate. So the first thing I'd want you to think about when you're thinking about your investment strategy is, what is it you're actually selling? what stage are you at? What is your commercial objective for that particular funding round? So what are the milestones and commercial milestones you're going to achieve? And remember, it's not just about the R, it's about the D and the C. So development and commercialization has to be part of that commercial objective. What's your strategic objective? So how does that unlock your strategic vision and help you work towards that? And also, it's really important to think about the culture of the organization. So what sort of organization are they buying into? What sort of company do you want to be seen as? How happy are your employees and how are they working together is also very important. And also think about the outcomes you're aiming for. So what sort of investor do you want on board? What sort of relationship? Do you want them to be the sort of investors who can bring on other investors if you reach those commercial milestones? Do you want them to be investors who can help you reach out once you've made those reach those commercial objectives to reach maybe customers or partners or supply chain partners? Think about that as well. And that will help you think about the ideal profile of the investor that you're looking for, the angels you want to engage with, and who you might want to bring on board. If you're going for investment, I would highly, highly recommend that you not only have a research sort of subgroup committee guiding group in your network or on your board, but you also have somebody who is there as your commercial guru or your commercial insights sort of advisory board. Really, really important. No matter how early you are, bring that in early on. So what are the pros of investment? It's more than just money. You can bring in those skills. So going back to the previous slide, what outcomes are you looking for? What are your strategic objectives by bringing these investors on board? And they will take risk. But the challenge with it is there's a requirement of an equity share, and depending on how much equity they are buying will depend on what role they want to have in your company and on your board. And also, it's not very easy to transition between rounds, particularly in the UK. We know that there's a big gap between early stage funding, the initial seed funding, maybe your first angel round is quite easy. There's a lot of money in the UK economy. It's when you're moving into that second chunk of funding and into that scalability before you've got traction, where it's a lot harder and it's a lot more competitive as well, because there's not as much money coming around, which is why British Business Bank and Innovate UK are putting together new products to try and address that. But it's still hard. So I want you to think about your investment progression. I mean, 50% of you have had investment, 50% of you are going to be going into that. You're going to start off with your bootstrapping. 35% of you had friends, family, and if you had the 6% from the university, that's that very early stage investment. And then as you're going up and your risk is decreasing, you're going to have access to different investors. Some angel investors will do high risk. Some angel investors will actually behave a little bit more like early stage VCs. So understand your investors' appetite. VC, definitely looking at your business, even at the early stage, about the potential to grow and scale. They'll be expecting a robust team that's credible at that point as well, or that you're building that as a really robust team, and they will be looking for a seat at the table, whether it's them as the lead investor or representation. And then for those of you who will sort of scale on out, you may have a trade sale, which could be a merger or an acquisition, or you might choose to float onto the alternative investment market. And that's where you leverage in large investment from products such as the banking products and pension funds. But what you'll track with that is your business size and also your profitability. So you don't have to be a huge company in numbers, but you may have to have the right turnover or the traction to segue between each of those those phases. So think about your investment progression, where and how many times you may be going back to angel investors and VC funding, and what is your exit strategy, how you're going to show that return to those investors later on, which is where the trade sale or IPO may come in. One of the things I'll say for all of you early stage is you've got to be very careful around how you promote your investment. You should only be promoting it to somebody who is either a sophisticated investor or is knowledgeable in the area. So it's to stop you trying to sell shares in your company and significant amount of money to friends and family who will take that risk without understanding what that means. I've seen it in people who've sent me LinkedIn and sent me also emails that, oh, can you promote this? We're going out there crowdfunding and doing X, Y, and Z. And you have to be a little bit careful about how and who you send that out to and how you promote. So the exemptions are investors and investment professionals, because obviously they sort of understand and know what they're doing. And what you'll find in some investment showcases, you can't talk about finance, or you're limited to what you can say, and the way they're promoted is as showcases. I've put in the link there for the information if you need some more you need to know about that. So do think about promotion, particularly if you're going down the crowdfunding or into your angel networks. So before I move on to investors, just a quick check if there's any Q&A. I can't see any questions that have come up, so I'll move on. So talking about investors and what they're looking for. So investors, they have very fixed criteria around what they're investing in, and they will be doing an audit across several sectors, and they will be making investments looking at different profiles of companies and different stages, and they will also be looking at what's happened in their current portfolio, and they'll be wanting to understand how you fit into what they've already invested in. So you need to do a lot of homework around your investors, understand what they like, what they don't like. If they're not interested in investing in your area, can they make introductions to people who might be? You want them to know about you so they can track you. You want to keep them updated around what you're doing in a way that's engaging and informative, and particularly in the sector that you're in. What I find is the investors tend to track to see what have you achieved with the funding or grant funding or investments you've got, how have you delivered as a team, and then there'll be a trigger point when you will be interesting for them as a portfolio. And one of the things we do with the showcases and the KTN quite often is we bring in the early as well as the later stage investors, because we want to make sure that the companies we work with are on the books, are known about, they can see who they are, what they're doing, and they can start that dialogue early on before they go out and look for investment maybe in 18 months or 2 years' time. So back to what they're looking for, a great team. So you really need to make sure you've got the right team around you, and you have to think about the advisors on your board. I said, making sure you've got a really good commercial team. Are they bringing you credibility? Are they giving you access to the market? You can change your boards and you can change your advisory boards. I would suggest having annual contracts with clear deliverables, with an understanding as you mature, what you might need at the later stage will be different to what you need at the beginning or in the middle. Be very open about that and how you're going to convene those groups. Your product, think about IP rights or know-how and how that's being managed. Think about how you fit in the market, your competitor analysis and all the rest of it. They're going to be looking for that IP position, particularly in this sector where IP and IP rights may be a lot more relevant than if I'm doing some of the work around the digital and the cybersecurity, where know-how and capabilities are a lot more relevant. So think about what you've got as both tangible and intangible assets, and think about building your brand and your brand name and reputation. You can start building a strong IP position around how you're recognized in the market quite early on, particularly if you're going to be disruptive. You're going to have to work a lot harder to convince people that your product and your opportunity is there. And people underestimate with disruptive technologies how hard you need to work to get into the market. So that then takes me into the market. IP position, strong IP position, has to segue into what your USPs are, what your key claims are, and whether they actually fit into that market and what you're planning on delivering. So I've audited for investors, I've done the due diligence, and what we've looked at has been around, are the main claims actually supporting that market opportunity and the way in which we're going to be delivering the products, goods and services within that market. Freedom to operate and all the rest of it comes in, but you know, how relevant is what you're doing around that. Show them you know what you're talking about. That's by having a proper direct and indirect competitor analysis, doing some good prioritization modeling, doing really good pestle analyses, particularly in the bioeconomy. There's a lot of political, economic and societal issues that you may need to overcome, not just around the research and the legislative, it's around people's perception and how you're going to engage with the public in order to be able to execute on your business plan. So a business plan has to fit in your research, your development and your commercialization plans. The numbers have to stack up, and you need to be able to show what your different funding requirements and needs are. You're in it for the long run. Our investors in this area really understand that it's a long haul. Valuation needs to be credible. That's a sticking point for a lot of people. There's lots of different models around that. Again, on our resource link, we have a link for one of our products, the Innovation Canvas, to all the different tools you can use. So you can have a look at that there. And then they're looking for a scalable company that's going to grow because it needs to be profitable. So making sure your D&U commercialization plan is scalable into the markets and the segments you're looking for, and making sure that you understand how you're going to reach those customers. So that's the key things that investors are looking for and what they'll be assessing on due diligence. So investors invest in a portfolio approach, which we talked about. So I said, you know, understand what they've invested in, whether it's an evergreen fund or a 10-year fund. So if it's a portfolio approach, imagine I'm an investment manager or my own personal wealth management. I've got 10 companies and I'm looking for a 25% return on investment of the money that I've put in. So assuming all 10 of those give me 25% return on investment, that's all well and good. But in reality, I'm probably going to have 5 of them that are going to fail. 2 of them are maybe break even. A couple of them might give me a 2-3 times return on investment. And that means that I've got to have that one company in my portfolio that's going to be the game changer. And that means on average, it'll be something like a 300% return on investment. So when you're looking at investors, look at the portfolio, what they've got in there, which are the companies they've got in there. Are they beginning to start building that portfolio, or are they towards the end of that portfolio? Because that will dictate the risk profile. If you're at the very beginning, you're probably more likely to think and be optimistic around all that 25%. Halfway through, you might be beginning to see which ones are likely to succeed or fail. And certainly towards the last 2 years of that, you're looking to those that are really going to give you a robust return on investment. So you're going to be a lot more conservative in investments you make. And the same with angel investors, actually. At the beginning of the year, they may be more conservative if they're using their SEIS, which we'll talk about. And later on, they might be a little bit more, well, I've got money to spend and before the year ends, so actually I'll want to make an investment. So timing is really critical. And that leads me on to angel investors. Angel investors are individuals who are taking their own personal wealth and they are going to buy a share in your company. If they're under SEIS, EIS, they have a limited sort of role they can have in directing where your company goes and what it does and how you spend that money, because there's a risk and a tax benefit to that. They offer great business experience and contacts. Deals can be anything from a 2 to 5K to 100 to £500,000 if you're working in syndicates and consortia and some of those angel platforms and angel clubs. 8 out of 10 deals in general are through syndication. And I know certainly with the angel groups that I work with, and I sit on a couple of them, they quite often follow on fund and support in difficult times. And they're looking for a 5 to 8 year exit or return, some of them longer depending on the sector they're in. They will typically see their money being returned when a significant VC comes on board and buys those shares. Typically it will be an evaluation with something like digital around a valuation of 2 to 3 million. In something like a bioeconomy, you're probably talking more around when you're going into the 5 million plus when they would see that return on investment. So good resource, UK Business Angel Association. So the thing to remember when you're talking to angel investors, it's around personal wealth management and that they enjoy it. They have fun doing it. They want to work with companies or support companies that they're going to enjoy, technology they're going to enjoy, areas they can help and bring value. And there's some really, really good angel investors out there, some really great ones. As we said, the tax benefit for them is around the seed enterprise and the enterprise investment schemes. If you're not familiar with those, look them up and think about when you need to apply for that. Those of you who've been around for a while, if you're pivoting your business, that pivot may still be eligible for enterprise investment scheme. If you need to consider that, have a tax talk to your sort of tax advisor. VC, as we've said, is typically larger sums. They're being invested through sort of syndication or individually. Some VCs will bring in other VCs that they've worked with. There's lots of due diligence. They require certain controls of the company. In some sectors are 3 to 5 years, actually more than 5 years in other sectors, particularly around sort of the sector industrial biotechnology, bioeconomy. They know the return on investment's a lot longer. And if you're going as an early stage and you say you're going to exit in 3 to 5 years, I wouldn't even bother putting that exit slide time down. I would say this is the sort of person who might acquire me or might be a joint venture, because they know the reality. It could be 10, 15 years. So don't be too hung up about the time for return on investment. Think more around what kind of exit strategy is likely to be suitable for your technology when you're talking with a VC. So VCs, it's about capital gain. So it's a stock-centric investment. They have a fund that they need to develop, and then they will sell that fund on, and it could be to a pension fund or a bank, another banking product, and then they would sell that, and then they would start reinvesting and building a new fund around that. Most of them, there's a flotation, might look at a flotation as well, so putting you onto the alternative investment market or onto the FTSE. That can happen, and they're promoting more, and there's some really good products now with the London Stock Exchange and the Elite program to help high growth companies think about the flotation rather than going into a merger acquisition. Elite program's very good for those of you further down the line and want to know about it. Google them and see what they do. They've got some really nice offers. So they're going to manage risk, and that's going to be on the company structure. So are you the right people for the roles? Do you have the right team? They will bring in different people and recommend you different people in there, and they will be looking at you from a portfolio approach. Corporate venturing is slightly different, and there's 2 different types of corporate venturing. There's those that are linked to the enterprise funds, so those R&D collaboration funds, and those that are completely disassociated. And those that are disassociated, they have complete independence in how they look at the portfolio. It can be done because it's for the pension funds, or they need to know about the technology, and can be completely disengaged from the core business. Others are very, very much strategically aligned, and they can see them actually using and working within them. So know what that corporate venturing fund is looking for. They're not just looking around returns on investment. It is around a strategic play. And you may need an internal R&D champion if it's linked to the enterprise funds, or some of that corporate venturing fund comes from the R&D budget, which can happen in some corporate funds. So the British Venture Capital Association's got some good guides. The links are in my resources. So public flotation, that is going to be, I think, early for all of you. It's around initial public offering. It goes on to sort of this sort of stock centric investors. So you're going to look at pension funds and all those big sort of players who would put into that. It's usually probably for around Series B investment or C when you're going for the growth around the A market. Said for those of you at that stage, have a look at the Elite program, which will give you some guidance. There are convertible loans. So that's a loan with a maturity date and interest, which you might get from a VC or an investor, and also some of the regional investment funds work that way. And basically that means that you get to a certain date. If you don't pay off the loan and the interest, then it'll be converted into shares, or there's assets that they can get their hands on. They're converted typically at a discounted rate to attract investors, and quite often can be used as bridging loans. Some of them are not well perceived by VCs. They can be inflate the valuation of your company at the early stage, which can cause some problems. And they can be converted into assets, not just equity. So that can be a challenge. So no questions. I'll move on how to find an investor. So preparing to find an investor, as I said, you've got your research strategy, you've got your development strategy. What is going to be your commercialization and your funding strategy around that? You need to think about your funding and investor strategy. Who are you going to go for? When? How does that link to milestones? Plot it all out. So you need to have a wide sales funnel. You need to understand who the investors are, what stage, what risk profile, when you might want to go back to them if you've reached a certain milestone, how you keep them informed and interested in you, so that may not be the right investor now, could be in 18 months' time. If you're very lucky and they're well primed, you could do it all in 3 to 6 months. A lot of the businesses I know, it's taking 9 to 12 months, and they are keeping their rounds open, but closing at a minimum amount, but keeping them open at a certain valuation. So be honest, be prepared to be flexible around that. You've got to practice your pitch, and make sure you've got a really clear value proposition, and you're flexible in terms of your valuation. You are worth what people are willing to pay. It's a lot of investors are very happy to give you some advice and guidance, particularly maybe the ones you'll be aiming for in the future, and ask them what they'd be looking for and what they'd recommend. And within the clusters, there's some great advisors I do know, so do use them. And you can use your EN networks and your sector networks as well for advice around that. Lead investors, good to find an experienced lead investor who's aligned to your business. Ideally, they sit and represent the investors on your advisory board, so somebody who everyone's confident with. So that's why having a sector expert is a good idea around that. They can help you set the valuation and the terms. They can help network with other investors, and ideally, they've got previous experience of investing and exiting business, or understand the process really well on the exit or return to the investors. And that's why I said, if you get a commercial board very early on and you get somebody on board that who can then act as a lead investor or introducer, that's a really great way of engaging somebody early on who could maybe have that role when you're at the right stage. To find them, there's lots around, but they don't wear badges. So look at your professional networks, look at incubators, accelerators, look at brokers. You can see from the cap tables in Companies House who's invested in companies like you. You'll see names of people if they're angel investors, but also syndicates and VCs. Have a look at LinkedIn, do Google searches around, who's invested in various funding rounds. Check out the trade associations and your regional networks. The angel networks have gone regional. UKBAA has got some really good regional support. BVCA is doing a lot of work as well. Accountancy firms will have high net worth individuals and networks they work with as well, and will make introductions. So I said, working with your local enterprise partnerships and those networks is great. Build a relationship, make sure you've got a really good due diligence sort of folder ready, so that you're ready to go, and make sure you've got some heads of terms in place when you start talking, so you're beginning to understand how you're going to negotiate. I would also say start building your brand recognition. So think about your awards, your pitches, showcases you're at, how those reported. Are you writing white papers or articles on LinkedIn? If I'm going to do my due diligence, I'm going to Google you and see who you are. Understand investor preferences and how they work from fellow entrepreneurs. I've made introductions of companies I'm working with to companies I know who've been invested in with early stage investors to share their experiences so they understand what the caveats are. Make sure your approach is personalized. It's about selling a vision. Remember, you haven't succeeded, you're looking to succeed. So how are you going to sell that vision? What's the quality of the material you've got? And you've got to keep that momentum and drive through the process. It is exhausting. So please think about how much money you need and what runway that's giving you, and how you can go about getting as much cash into the business to give you a really good foundation. So in conclusion, when you're looking about your funding and finance journey, it's a cocktail of funding you need to be thinking of. So think about grants, think about the in-kind stuff you might get, think about how you're going to collaborate with your customers, your end users, your potential partners, think about your investment requirements, think about when the trigger points are on key milestones that are going to unlock that investment. And most importantly, it's a really, really competitive landscape. So you need to stand out from the crowd. So think about what it is you can do now and to start building up your presence, people's understanding of you, how your USPs stand out, how you go about promoting that, and how you go about talking around that. Think about your LinkedIn pages, your Twitter, your websites, any marketing material. How are investors going to hear about you? How are they going to, if they search for you, what are they going to see? And how do you stand out from your competitors? And at that point, I'm going to wish you all a very good luck and open up for questions. And just to say, we're going to be sharing these slides for you. So these are the resources and the links to the various sites that I talked about for you, which will give you some useful information. So any questions?
Thank you, Emma. I think it was a really good overview of all the options out there. So if any one of you has any questions, if you don't really feel comfortable putting them in the Q&A box, I think we are happy if you send us an email and we can take them offline.
Do you have to have a physical developed product, or can it be an idea that's developed into a fantastic product? Well, the question is what are you selling? If you are an entrepreneur with a track record of taking technologies, I have seen people build the team and the idea and raise significant funding. And I've seen literally £500,000 go in on an idea because their track record, they know the market, they know what to do. So what you can think about is what have you actually got that you are selling to an investor, and actually if it's that early stage, what grant funding could you have, maybe on the open calls or in one of the thematic ones around that, to sort of start developing that product to the offer. And remember, some of the offers we look at are actually services, so they could be around a service offer, etc. So you've got to think about what people are buying, what they're investing in, and there are other ways of doing it.
Thank you, Emma.
I think I've stunned everybody into silence. Hopefully,
yeah, I think
got all the information you needed.
Yes, there's lots of information, and as Emma said, the link will be sent out so you can listen to all the information again. And then if there are any other questions coming up, please feel free to contact us and we can discuss your funding opportunities further. Okay, I think with this, oh, hang on, there's one coming in. Emma, you wanna-
Life science private investment is as strong as public investment currently? Really interesting question. I am seeing that angel investors tend to shy away from life sciences long-term return on investments, unless they can see some like diagnostics, etc. I am seeing that the government funding, obviously with the COVID-19 and the recovery and the fact the life sciences sector has been really badly hit, are doing an awful lot to sort of support the clinical trials. And I'm saying that the life sciences private investment is going into actually supporting their existing portfolio. However, what we have seen is that the investment community has not been as badly hit by COVID-19 as they thought they were. So there are funds that are actually opening up. So at the beginning it was hunker down, how can we manage our existing portfolio? And there are opening up now. And products like the Innovate UK kind of linking in VC funding with and investor funding with grants is proving to be quite popular because it's sort of reducing the risk. So I think the shift is sort of coming back to what it was like beforehand, but it depends on the investment portfolio. So if you are in that kind of life sciences and human health, you're probably going to see a difference in what you're doing compared to if you're in the agri-tech or in the industrial biotechnology sector, where you're actually people are working towards sustainable development goals. And one thing I would like to add to that is there's a huge shift in investors now, and it's COVID-19 has accelerated this, around impact investment. And actually invest in portfolios, particularly the larger pension funds and the corporate funds, they are looking for impact investments where they have a social development goal credit associated with them. And what they're looking for are things like a healthy planet, sustainability, sustainable societies, robust institutions, basic needs coming into that. And so some of the portfolios are lacking in investments that actually meet those goals and targets that their portfolio, the funders of their portfolio are looking for. So what I am finding is that if you are in the kind of life sciences, net zero, those kind of areas, if you can show how you fit in under the social development goal, impact investments, and how you can improve those credits, and it could be not only around the healthy humans and society, but actually around sustainability, lower carbon, reducing waste streams on processes or improved processes, and you can put all those things in, you suddenly become a lot more attractive to those investors. So look at that. And also equality, diversity and inclusivity is another really big factor that we're seeing being cascaded down from pension funds, corporate funds, and it's going into the VC funds as well. So do look at that in context of your offer.
Okay, thank you, Emma. And with this, I'm going to close today's webinar. Enjoy the rest of your day.
Thanks, everyone.